Today, we will talk about business valuation methods for determining a company's worth. So before we get started, make sure to hit that like button, also subscribe to my channel. As you might imagine, determining the value of a business isn't simple. It requires accounting for a number of factors within your business finances. Because this process is so complex, many business owners choose to work with a professional to receive an objective, thorough evaluation of what their business is worth. This being said, if you need to determine the value of your business, it's worth understanding how this process works, even if you ultimately decide to hire a professional. In this guide, therefore, we'll break down the 7 most common business valuation methods, how they work, and how each approach may, or may not, be beneficial to your small business. What is business valuation? At the most basic level, business valuation is the process by which the economic worth of a company is determined. As we mentioned, there are different approaches to evaluating the value of a small business, but generally, each method will involve a full and objective assessment of every piece of your company. This being said, business valuation calculations typically include the worth of your equipment, inventory, property, liquid assets, and anything else of economic value that your company owns. Other factors that might come into play are your management structure, projected earnings, share price, revenue, and more. Why would you need a business valuation? Due to the complexity of the business valuation process, these calculations are probably not something you'll be doing every day. Ultimately, different small business valuation methods will be preferable in different scenarios. Generally, the best approach will depend on why the valuation is needed, the size of your business, your industry, and other factors. As an example, in a sales scenario, the majority of private small businesses are sold as asset sales, whereas the majority of middle market transactions involve the sale of equity. Each of these sales would require a different business valuation method. Market value valuation method. First, the market value business valuation formula is perhaps the most subjective approach to measuring a business's worth. This method determines the value of your business by comparing it to similar businesses that have sold. Of course, this method only works for businesses that can access sufficient market data on their competitors. In this way, the market value method is a particularly challenging approach for sole proprietors, for instance, because it's difficult to find comparative data on the sale of similar businesses, as sole proprietorships are individually owned. This being said, because this small business valuation method is relatively imprecise, your business's worth will ultimately be based on negotiation, especially if you're selling your business or seeking an investor. Although you may be able to convince a buyer of your business's worth based on immeasurable factors, it's unlikely that this approach will be particularly useful for gaining investors. Asset-based valuation method. Next, you might use an asset-based business valuation method to determine what your company is worth. As the name suggests, this type of approach considers your business's total net asset value, minus the value of its total liabilities, according to your balance sheet. Businesses that plan to continue operating, not be liquidated, and not immediately sell any of their assets should use the going concern approach to asset-based business valuation. This formula takes into account the business's current total equity, in other words, your assets minus liabilities. ROI-based valuation method. An ROI-based business valuation method evaluates the value of your company based on your company's profit and what kind of return on investment, ROI, an investor could potentially receive for buying into your business. Here's an example. If you're pitching your business to a group of investors to get equity financing, they'll start with a valuation percentage of 100%. If you're asking for $250,000 in exchange for 25% of your business, then you're using the ROI-based method to determine the value of your business as you present this offer to the investors. To explain, if you divide the amount by the percentage offered, so $250,000 divided by 0.25, you receive your quick business valuation. In this case, $1 million. Discounted cash flow, DCF, valuation method. Although the 3 business valuation methods above are sometimes considered the most common, they're not the only options out there. In fact, whereas the ROI-based and market value-based methods are extremely subjective. Some alternate approaches, as we'll discuss, use more of your business's financial data to get a better evaluation of its worth. The discounted cash flow valuation method, also known as the income approach, for example, values a business based on its projected cash flow, adjusted or discounted to its present value. Multiples of earnings valuation method. Similar to the capitalization of earnings valuation method, the multiple of earnings valuation method also determines a business's value by its potential to earn in the future. This being said, however, this small business valuation method, also known as the time revenue method, calculates a business's maximum worth by assigning a multiplier to its current revenue. Multipliers vary according to industry, economic climate, and other factors. Book value valuation method. Finally, the book value method calculates the value of your business at a given moment in time by looking at your balance sheet. With this approach, your balance sheet is used to calculate the value of your equity, or total assets minus total liabilities, and this value represents your business's worth. Finding a business valuation professional. Although understanding the different business valuation methods is important, if you do need to evaluate the worth of your business, it's best to work with a professional. Although the approaches may seem simple enough on the surface, as we saw with the DCF example above, there are extensive and complex calculations involved in determining the value of a business. This being said, not only will a professional be able to offer you an objective examination of your business, but they'll likely be able to combine multiple business valuation methods to get you the most thorough sense of what your business is worth. Therefore, if you need a business valuation professional, you'll want to know where to find one. Generally, you'll want to look for an individual who is a certified business valuation professional. What do you think about our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.